Okay, so very good evening once again. Today we have come up to you with a very interesting theme, which is evolving, uh, especially after one big event which has gone by us, and we are about to witness another important event of the year, which is the budget. So we thought, why not look at some election numbers, what has been the outcome that is already known to us, and what is it for us in store, what is it that we can look forward as investment fraternity. And to address that, we have got two fund managers for you today evening. I will briefly introduce both of them to you. We have Pankaj Pathak. Pankaj is a qualified CFA and has been managing our fixed income desk since past few years. We also have with us Christy. Christy is also a certified financial analyst and manages few of our equity funds. Both of these gentlemen will today be talking about what is it our analysis about the upcoming budget event, what is the likelihood of impact on our portfolios. We will have a small presentation for you, and after the presentation, we will have a question and answer session. I would request for anybody who has got a question can write the same in the chat box, and I shall be able to comprehend that and ask with the fund managers. So with this, I hand over the presentation to Pankaj for his comments and opening slides. Thank you.
Good evening, everyone, and thank you all for taking time out and joining us this event. So we are hearing about the election outcome and how this time the government is a little different from the past two, where one party had a large mandate, and this time this is a more like a coalition government. And in past, what we have seen, the policies or the fund allocation has been slightly different for these kind of setups. So we'll try to see what has happened in the past, what has been the policy direction, especially the fiscal policy, and what can come in the upcoming budget this time. So till now, especially coming out of COVID, the fiscal policy had set two priorities. One of the priority is to reduce the fiscal deficit and the government debt level. So the general government debt level, which include both the center and the state government debt. As we all know, during the COVID, the economy was shut down. That led to large fiscal deficit for the government for spending for various purposes, for boosting capex, providing some sort of relief during the COVID period. And the fiscal deficit jumped to almost 9.2% of GDP in that year. Thereafter, 2020, FY22 onwards, the government set an aim to reduce the fiscal deficit to 4.5% of GDP by FY26. So we have been on that path. If you look at the glide path, the chart on the left-hand side, the fiscal deficit has been coming down from 6.7 to 6.4, and now for the FY25 in the interim budget, it was targeted at 5.1% of GDP. Same way, the debt to GDP number was also coming down. So there are two dynamics there. One is the debt level, how it's growing, and the other part is the GDP, how it recovers. So we have seen two high nominal growth period in FY22 and FY23 because of high inflation, and that led to a significant drop in our debt levels. But reduction in fiscal deficit is also contributing to more manageable debt levels. Now, that is one priority where government is trying to reduce its fiscal deficit. The other priority was to boost capital expenditure, and that was with a more medium-term growth potential outlook, where government was trying to boost the growth potential by putting more capex, more investment. And the hope was that this government capex will crowd in private sector as well, where private sector will also put more investments in the economy. If you look at the expenditure pattern, this priority kind of where the expenditure allocation, the spending allocation shifted more towards capex, and from FY 2021, where government total expenditure, out of total expenditure, around 10 to 12% was going into capex. Now that number is somewhere close to 24%, so just about 23%. So in the 4-year periods, they have kind of doubled their allocation as percentage of their total expenditure to capex. It shows clearly how government has been focusing on capex. Now, these two priorities are in conflict to each other. The consolidation, fiscal consolidation, require government to reduce their spending, while on the other hand, they are spending more on capex. Now, the casualty in this process became the other spending. So all the non-capex spending, especially the welfare-related spending. So on the right-hand side chart, you can see the expenditure on, say, food subsidies, job guarantees, basically NREGA, which guarantees job to rural folks, and the income guarantee, mainly the PM Kisan and all these schemes. So expenditure on these kind of schemes that declines substantially, and you can see in the chart how it has come down from first 23% to 12%. It's understandable because FY 21 was the COVID year, but since then from 12% to now around 7.4%. So now at a broader level, when I look at this budget, these priorities looks justified. One, that reduction in fiscal deficit to more manageable level, that gives us more macro stability, right? So that's always better for economy. It reduces the overall risk in the economy. And also boosting capex creates or boosts the growth potential of the economy over the medium term. So a good thing to do. But the sad part in this, or the I would say the flip side of this fiscal allocation, was that there was a stark divergence between different growth drivers within the economy. And same way, the benefits of the economic growth was distributed in a very different way within the broader population. So the growth recovery out of COVID was driven primarily by capital formation, because of especially led by government's investments or the capex, what I have shown in the previous slides. While the other part, which is much larger part, consumption, which is 60% of the economy, has been growing at a much sluggish pace. And this you can see in the table and the chart, where the cumulative growth between FY 20 to 24, almost 30%, the capex grew by almost 30% during this period, while the consumption expenditure, especially the private consumption expenditure, was much slower at 17% growth. And this is also slower than what we have observed before COVID, the 4-year period before COVID. These numbers were significantly different. So the demand situation is still very weak. And within the demand segment, the distribution of demand is more skewed towards the higher income segment or the economically stronger sector of the economy, while the weaker section is still struggling or haven't even recovered from the COVID shock. So this is where we stand. Now the key question is why this trickle down is not working. Ideally, when you are putting money, you are creating capex spending that creates job, especially the construction. When it grew in past, we have seen that creates a lot of job, and then that gives consumption boost. But this time, it's not playing out that way. So it presents some hurdles for the further economic growth, and that presents a case for reallocation of government's expenditure. Now, what are the hurdles? So one, that despite this capex growth, it's not leading to that level of job creation and income distribution, which can create more demand in the economy. And not having enough demand is again restrictive for the private investment. So despite government pushing for capex for the last 4 years, we have not seen any material pickup in private capex. And one of the reasons being that the demand conditions are not that favorable. So whether this condition is sustainable, whether the government can push on the supply side and leave the demand side completely untouched, or there could be some relocation of the expenditure within the broader fiscal consolidation objective to boost demand. And we are kind of expecting some bit of boost towards the demand-led schemes, or where they can fuel more demand. And especially given the entire uneven economic recovery and even slowing global economy, it is kind of becoming necessary. So we have seen some of the schemes where government has been really active in the past, and that has given a decent push to demand. Schemes like the PM Awas Yojana, the housing scheme for both urban and rural poor. Rural road schemes, another big project where it created a lot of job at the micro level. The livelihood promotion scheme, irrigation related work. So these schemes have some multiplier effect as well. They are not handout, but they create some asset and also provides a job at a more broader level. So we might see some push for these kind of schemes. Also, there has been talks about increasing exemption limit for income tax, and that might come. There are some rumors. So if these things happen, there could be a broader boost to overall demand. So broadly, this is how we are thinking that maybe overall government will stick to the fiscal consolidation roadmap, what they have been following till now. They will probably maintain their push towards capex, which is required for the Indian economy or to boost its medium-term growth potential. But within the overall expenditure, there could be some reallocation, there could be some shifts in the expenditure between different schemes to give some flip to demand as well. Now for FY25, this is much easier to do it, given government has received a large dividend. This was after the budget, so it was not part of the interim budget. There is the additional money what government has now. So RBI has given 2.11 lakh crore of dividend to the government. So this bounty can be utilized in this year to fund these kind of schemes or to give some boost to the broader economy or the demand. But FY22, FY26 onwards, probably we'll see more measured approach where we'll see some shifting away from capex towards more of demand boosting expenditure. Now, how that's going to impact different asset classes or how we should position for it. So as I said that for this year, FY25, these reallocation or demand boost can be easily accommodated. So we are not expecting any kind of a deviation from the fiscal consolidation roadmap. For the fixed income, I think the fiscal deficit will remain the key focus going into the budget, because that determines the overall demand supply balance in the fixed income market. And we have been fairly positive and very constructive on the long duration bonds for last many months, and we maintain our positive outlook. So it's mainly driven by two factors. One is that a structural demand supply shift in the fixed income market, where we are seeing supply of government bond declining because government is reducing its deficit, and consequently their borrowing is also coming down. At the same time, we are seeing increasing demand from domestic institutional players, especially very long-term players like insurance companies, pension funds, etc., which kind of a result of broader financialization trend. And they are big buyers of bonds. So demand is rising and supply is kind of falling. That gives boost to their prices. Prices go up and bond yields go down in this kind of environment. At the same time, Indian bonds are getting included in the JP Morgan GPI EM index. So, and many others. So, like Bloomberg local currency index will also include India by early next year. So, these global index inclusions that also might attract a lot of foreign flows into Indian bonds. So, overall demand side looks much stronger while supply is falling, and that's one positive backdrop for Indian bonds. The other side is the cyclical, where we have seen cyclical downturn in inflation. Inflation has been coming down for more than a year now. And if you remove the volatile vegetable component, which is 6% of the inflation basket, the rest of the 94% of CPI basket is much below RBI's target of 4%. So it's just about time that monetary policy will turn and RBI will start cutting rate. We don't know when they will start, but most likely we'll see maybe rate cutting starting from October or December of this year. So when RBI cuts interest rates, bond prices go up, and that's again positive for long-term bonds. So these two factors will remain a positive driver for bonds, while there could be some expenditure switching towards more demand boosting. But I think bond market will be driven by these two factors and respond positively only. Overall, from the investors' point of view, I think dynamic bond funds are probably the best place to capture this opportunity. Now, in dynamic bond funds, we have flexibility to change the portfolio allocation depending on the market environment or the outlook. So currently, as we are positioned positively invested more in long-term bonds, but if something changes, there is a flexibility with the fund to respond and reduce the portfolio duration or maturity immediately. So that makes this fund really favorable for most of the long-term fixed income investors. Investors who have shorter holding period, they can't tolerate much of volatility. I think liquid funds remain a best option. They should stick with the liquid fund. And they're also, given the overall liquidity situation and all, returns have been reasonably high for the last 1.5 years, and I think that will continue in future. So that's all on the fixed income side and what we can expect in the budget. With that, I'll hand over to Christy for to take you through the equity outlook. Christy?
Yeah, thanks. Thanks, Pankaj, for that perspective. So we'll quickly move to the equity part. Pankaj, if you can just move the slides. Yes. So just before, beginning, talking about budget, we just had elections and so on and so forth. So these are events that keeps happening, at a, there are, let's say election is a 5-year event, budget happens annually, and there are certain other factors that keeps investors in that sense quite active in the market. But it is always important to look at something which has been the key USP of quantum long-term equity fund, of for that matter quantum tax saving fund. So this is a chart. For some of us, we would have looked at this chart, but I just want to reiterate, at every point in time, whenever you look at a quantum long-term equity portfolio, we have a defined buy and sell price for each and every stock. And if you were to aggregate all the stocks in our portfolio and were to look at what is the 2-year out upside potential for that particular stock, this is that chart. And what we said, basis our research, is in, since inception, that's over about 18 years, the QLTF at various point in time, according to our estimates, should have given around 13.9% CAGR, And if you move to the next slide, which actually shows you the actual NAV of how, how your NAV post the expense have turned out to be. It's around 14.3% CAGR. And if you were to, fit both the charts, which is on the next slide, you would see there is a very beautiful fit, which just tells you the process of value investing and being disciplined about picking stocks, having a defined buy and sell price, and acting in line with that process delivers a very uh, perfect results over a very long period of time. There are some global dislocations like GFC crisis, COVID-19, where the actual NAV fall might be a bit higher than what we had anticipated, but these are very difficult to predict. And over a long term, what we see is more or less the NAV catches up to what our estimates are. So just put this in your backdrop when we are thinking about elections, budgets, and so on and so forth, which keeps happening, and they are largely transitory in our view. But this chart should be able to tell you that the process of long-term investing would sort of give you those returns that we have been able to generate over the past since inception in that sense. Now, just moving on to budget. Uh, so as Pankaj said, Pankaj gave that macro perspective. I'm broadly going to be looking at how the equity market reads some of the data points which Pankaj shared. So starting with capex spend, this is the government budgeted capex spend over the past so many years, and we have been seeing a steady increase in the capex. So the last uh, capex as a percentage of GDP was around 3.2%, and bulk of this is into three sectors broadly. It is into road, railways, and defense. So these are the bulk of the spend that the government has thought about in terms of capex. And if you move to the next slide, what we see, yeah, if you can move to the next slide, yeah, what we see is this is a listed capex order book of a lot of engineering and construction companies. It's in the actual listed universe. So these capex spent by government has resulted in increased order book. So there is a large backlog of order book with respect to engineering and construction companies. This includes the likes of power, construction, real estate developers, and so on and so forth. So everybody has seen a steady increase in their order books, and the execution pace by majority of them has been good. For example, on the power side, nobody expected 2 years back that India would, in fact, require so much of thermal capacity. And what we are seeing in the past 2 years is the power demand is through the roof. There is an increasing tendency. Government also in its plans have said that we need to put up more thermal capacities, even though renewable pipeline remains strong. So that has led to a lot of ordering, which to the likes of NTPC, Power Grid, and so on and so forth. Now, once they get this order, they kind of pass it on to their suppliers. Would be a lot of engineering companies which would see that demand flow through. And if you see the next slide, there has been a substantial re-rating in majority of these stocks. I've specifically taken 2020 because this is when government sort of launched into that overdrive on capex. And what we see is the returns of some of these sectors like capital goods, power sector, real estate. They have broadly done much better than what we see the frontline indices like Sensex. I have not put defense because there is no index as such, but it has done even better. But what has suffered in this process, again, this is the equity lens, is the FMCG part where the returns was trailing the Sensex returns, as you could see. And these are some of the numbers, over the past 3 years, the the listed major FMCG players, if you were to look at their volume growth, it has been pretty pedestrian, especially for the multiples that they command, right? And for example, if you were to look the likes of HUL, which is possibly the largest reach in the country, so some of these FMCG companies which are smaller can grow volumes basis, distribution reach increase. But for a player like HUL, which is fairly large, the volume growth has been pedestrian. There is some bit of price increase that people have taken, but more or less the volume growth is pretty pedestrian. And what is the reason for it? As Pankaj said, the consumption part of the economy has not really done well. And many of these companies cater to rural India, where if you were to add the inflation impact of the RM price going up and lack of income growth, most of them would have down traded, in their consumption basket. And this is also true of the likes of two-wheelers. For example, if you were to look at the listed large two-wheeler players, which kind of look at cater to the mass end of consumption, they have also suffered. So that as a backseat, uh, you know, so the consumption clearly has been on a backseat, and that's a backdrop. If you were to look at now what probably the government priorities are, and moving on, uh, the last slide. Yeah. So these are some of the things that we can expect from the budget. As Pankaj alluded to there, ideally ought to be the shift to consumption. Now that is a speculation. We don't really know what will happen because uh, government has some money to spend in terms of the RBI dividend that they've got. So this year possibly things might continue the way it is. But these are some of the things that we think in the major sectors there could be certain changes. So if you were to think about financials, which largely include the banks, we think the capex push that we have seen should ideally continue at least this year. We don't think that will take a back seat, and this eventually helps the corporate part of the banks in terms of growth. Most of these order, for example, something like the likes of NTPC or Power Grid, they would typically take loans from the banks, because for example, if they were to do a power plant construction, 100 rupees of capex, generally they put 30% of their own equity and 70% is financed by debt. So where will they go for debt? Either they'll go to some of these banks, or they'll go to some of the NBFCs, the Power Finance Corporation, and so on and so forth. So that corporate growth should continue and help. And slowly what we are seeing is the corporate growth is slowly picking up, though the private part of it remains pretty poor. We don't expect any major PSB recapitalization because you look at all public sector banks, they are in the cream of health. All of them have adequate capital adequacy ratios. The NPAs are at a decadal low, credit costs are decadal low. So we don't think there'll be a need for infusing any money into some of these banks. Even as Pankaj also spoke about, affordable segment is something that possibly the government may be looking at, and especially within the mortgage space, affordable housing finance companies can benefit through such a measure where they are trying to increase the ownership. So for example, a rural household builds a house, so it leads to cement demand. The whole economy sort of thrives when the construction sort of begin in such an economy. So affordable housing finance companies can benefit. We also possibly expect some tweaks within the insurance space. Last year also we saw in certain let's say more than 5 lakh sort of ticket sizes, government went ahead and increased the tax rate to marginal tax. So we still believe there are some loopholes within, if you were to look at the taxation within insurance, which can be detrimental to some of these companies. The other major theme is, especially on the infra and building materials, we think the traction will still continue within the railway, road, and defense. So the order books that you saw will possibly increase even going forward. And some of these incentives, so some of these infra push should help, case in point, cement or building materials doing well. Cement could be a major beneficiary, especially of the affordable housing, because a lot of the demand is from retail channel for majority of the cement companies, so they can help. And power sector also need to add more capex, especially on the thermal side. There are a lot of talks on renewable, and that's happening, but at a slow pace. And you cannot ignore the thermal power consumption, capacity addition, which will continue to be strong. We don't know what sort of stimulus the government would give to reignite, let's say, the consumption, be it welfare scheme, some sort of tax cut. It's difficult to know. But again, it's a speculation, but a high probability speculation that something of that sort might come and should help majority of the FMCG pack, especially the folks who are more rural focused. Also the two-wheelers, because what we see, the two-wheeler demand has slowly started inching up starting last year. And I think such a move should more than help, in the earnings growth there. Some of the large ticket disinvestments that, has been spoken in the past, given the coalition nature of the government that is in power, we think some of them can be on the back burner. So that remains to be seen how those things will pan out. Uh, Next slide. Yeah. So with that as a backdrop, you always need to ask this question. While these are the positives that can possibly come, but what is actually in the price, right? And for us also, it's very important when we're looking at picking stocks. So most of these themes would mostly be known by the market, and chances are some of these stocks or sectors would have done well. For example, if you were to just look at how consumer staples have turned out post elections, it is, they have had a one-way rally. Most of the consumer staples, which have been laggards for quite some time, for 3 years, in fact. So some of these inputs are pricing. So it is very important for us to fix valuations as a key driver of us picking stocks, right? So valuation in the broader indices, in the frontline indices, BSE Sensex, if you look, it remains tad bit higher than what has been historical. But there is something. There is an issue with this particular chart, and the issue is like in the past 2 years, some of the public sector banks, some of these government uh, companies have made tremendous profits. It is almost the profits are decadal high. And when you bake that in computing your trailing 12-month multiples, because the base is so big, even though valuations have run up, so your multiples may not show the actual picture. When you assumed a normalized earnings, the multiples might be a bit higher than what we see. So valuation in our minds are not cheap at the moment, and the situation could be more worse in some of the broader indices. So we have to be very careful in terms of stock picking. Moving to next slide. So this is how we are positioned in QLTF. So large portion of our portfolio remains in financials, mostly banks, which we think would be a net beneficiary, of the ongoing private capex as and when it ensues. If that were not to happen, we see a reasonably good credit growth continuing, despite the RBI interventions that what we have seen. So that remains a pocket of, attraction for us, and it is fairly valued in our view. It is some of the private sector banks are trading at fairly reasonable valuation with respect to its own history. So that remains bulk of our allocation within the financial pack. Consumer discretionary, again, we are not changing our allocation basis, this budget, what can possibly come out, because for us that valuation is very important. And we got into some of these mass consumption themes, be it two-wheelers, about 2 or 3 years back, when the volume growth was not coming, and hence a lot of selling had happened in those stocks, and we were able to get into some of those stocks at fairly attractive valuations. And what we have seen is slowly the volume growth has just started picking up since the last year and a half. So any further boost would eventually help in increasing the EPS going forward. So we remains positioned well there, but slowly we are trimming our allocation in consumers discretionary also, because the valuations have moved up quite sharply. If you see, we have also cut our allocations to a lot of utilities, some of those PSU names that we traditionally used to have. Again, primarily driven by the fact that we think some of them have reached their fair valuations in the rally that happened in the past 2-3 years, especially in the PSU pack. So we've been trimming or exiting out of those stocks. The other large allocation remains IT, which is in a way not impacted by budget. So maybe I'll stop at that, and we could open up for questions.
Yeah. Thanks, Pankaj. Thanks, Christy, for the slides. And while I would request the investors to kindly put their questions in the chat box in case you have any. In the meantime, there are some pre-submitted questions which I would like to ask till the time we have the queue assembled. Christy, you mentioned about some important sectors that we need to look at. However, can you also highlight some of key budget indicators which then investors should keep in mind while looking at their portfolios and uh, what can be the impact as far as budget is concerned?
Yeah, so one submission I'd like to make is like budget has lost in a way the relevance to equity markets over a very long period of time, because earlier there used to be a lot of taxation changes, and people used to look at which sectors possibly would get the tax benefit. But a lot of that has changed ever since the GST was introduced, and we don't see much taxation changes which would eventually go on to impact the equity sort of returns, right? So that is clearly a big change. So, but it is a big exercise, and government is setting up its budget, and it has impact on sectors and so on and so forth. So some of these sectors which I spoke about are kind of the key sectors. But I think one of the things that I would be also watching out for is any change in capital gains, because we have seen the first time it was introduced, it had a very negative impact on the markets. There are some speculations about it, so we would have to really watch about that. But other than that, broadly, my suggestion to investors is, most of what people presume, like about budget, be it this whole shift from investment to consumption, most of it is already baked into what we see in the stock returns now. So there is no point playing. You should be very disciplined to pick up the right stock at the right valuation. So I think that is of more importance, rather than rejigging quite dramatically the portfolio. I think chances of that, such dramatic changes are very seldom.
Okay, sure. Question to Pankaj from one of the investors is that what is the outlook for the interest rates for over next 2 to 3 years, and what could be the good options for the fixed income investor at this stage, Pankaj?
Yeah, so in my presentation, I already showed that there are two major drivers which are kind of driving the fixed income market, and that will probably remain there for longer periods. So maybe next 1 2 year period. So one big thing is the demand supply, which is more structural. And as I said, the government, when initially started the consolidation process, they set the fiscal deficit target to 4.5% of GDP by FY26. So that gives a very favorable demand supply balance for the fixed income market, where demand is more than supply. Now, the expectation is that in this budget or the next budget, government will probably show the medium-term fiscal outlook, where the fiscal deficit target can eventually go down to 3% of GDP, which is considered to be more sustainable level of fiscal deficit in India. So if that has to happen, the borrowing of government, especially the central government, will continue to decline over the next many years. And that's a very favorable demand supply balance for the bond market for a very long period of time. So that is one thing I think which will continue to drive bond yields lower over next 2 3 year period. Apart from that, the monetary policy cycle is also turning. As I said, that RBI will probably start cutting rate by the end of this year. Most of the global central banks have started cutting rate, except for US Fed. So I'm expecting many more advanced economies, especially, they will start cutting rate by the end of this year. So it is expected that there will be a global synchronized rate cutting cycle by the end of this year and the next year. Now, with that backdrop, we are expecting bond yields to go down over the next 1 2 year period and sustain there for longer periods. So the biggest risk investors facing this time is a reinvestment risk, right? So if you are, say, locking your fixed deposit at 6-7%. After 1 year, when you roll over, going to roll over, that time you'll probably get much lower interest rate than what you are getting now. So in terms of where investors should invest in this kind of environment where we have a declining interest rate outlook, to be invested in the longer term bonds or longer funds which are investing in longer term bonds. So I think a dynamic bond fund, as I said, is a good option in this kind of environment, which kind of invests in long term bond and same time has flexibility to change it if say things go other way. You always have the option to change the allocation and investors can remain invested for longer time period. Yeah, so I think this is how I see the fixed income market now.
Great. Continuing with you, Pankaj, there's another question which is basically about the potential rating upgrade which India may witness. Do you think that increase in government spending can hamper that? And do you really think India will get a rating upgrade this time?
Yeah, so one, I think for FY25, as I said, we have enough buffer. There is a RBI dividend which kind of give enough room to government to spend more without compromising on fiscal consolidation. So I think rating agencies recognize this fact. We have seen that in their latest commentary as well, where they accounted for these things and gave a positive outlook. Apart from that, if you look at the track record of this government, see, though this is a coalition government, the dominant party is still holding all the key ministries. So there is a sense of continuity. And if you look back how they have managed the fiscal balances, they have been very prudent about managing fiscal deficit. So in the NDA 1 between 2014 to 19, the fiscal deficit was brought down from almost 4.5% to closer to 3.4%. And it was staying there for almost the entire tenure. In the NDA 2, there was a big shock. We all know about the COVID-19 and how it kind of distorted everything in the economy. And the fiscal boost was needed. But thereafter, they have followed a very disciplined fiscal consolidation path. So I think there is a strong case. They will remain on this fiscal consolidation path, and that will probably give enough margin or comfort to rating agencies to actually look at India positively. Now, as far as whether this we will see a rating upgrade or not, I think there are many improvements that can be accounted for. So one, as I said, government has been disciplined about reducing their fiscal deficit and overall debt level. But yes, our debt levels are still very high compared to most of the similar rated emerging economies. But at the same time, our growth rate is also very high compared to most of the similar rated emerging economies. So if our economy is growing in double digit in nominal terms, our debt level as a GDP, percentage of GDP will continue to decline over the years. So that's one part. Also in the past, rating agencies raised concern about health of the financial sector or health of the corporate sector in India. And we have seen significant improvement in both the balance sheets, both the private balance sheets and the financial sector health. So I think that will also provide some comfort. So yes, I do see chances of rating upgrade this time. This time we have seen even the S&P upgrading India's outlook, and probably in next 1-2 years, whenever they get more comfortable and see sustainability, I think that's the time when we'll probably get a rating upgrade.
Sure. I have one last question for Christy. Christy, what can you share with us any historical trends that actually show that post-election budgets have had some kind of influence on the markets?
Yeah, sure. So actually, I'll start with 2016, 2017, if I remember right. Those, one was the capital gains increase that was brought about, and that is a dramatic impact on the market. And I think it took quite a bit of time for the market to really come to that reality. But in a way, the taxation is lower than what we see globally, but it took quite a bit of time for the market to recover from that pain. Then there were certain changes with respect to FPI, how they could invest. There were a lot of uncertainty, and the government kind of had to go back on what they sort of proposed. We remember the last year's election itself, where the insurance stocks were really got hammered because there was a substantial increase, basically from very low taxation to marginal tax rate in some of the insurance policies, non-ULIP policies above 5 lakhs. So these are some of the things that can keep happening, and I think one of the bigger trend, which was what I was highlighting from FY20, was this whole capex spend and what impact. I think that is clearly the biggest, that what we have seen for a very long period of time, that how that capex kind of moved into order books of so many companies across cap goods, across defense, across power sector, and the splendid returns that market beating returns that you had with respect to benchmark. So some of these are clear trends, but what we have seen, there are it is not like there could be some dramatic changes. It comes in a phased manner, like these steps are built on top of each other. So had the capex intensity been high in FY20 and it suddenly kind of came off in FY21, we would not have seen that the continuity of all those sectors. So I think these reforms build on top of each other, and I think one budget is just one point in time. It has to be, there had to be more progressive, lawmaking in that sense. So yeah, these some things which come to my mind.
Sure. Investors, any further question? You may put your questions in the chat box, or you may ask. We'll wait for another minute. Okay, so I hope today's session with both Pankaj and Christy give us some clarity about what to expect from the budget. Largely, it is an event which will pass by on itself. There are few sectors which may get impacted. However, idea is that we should stay invested and not really making any hasty decisions in anticipation of it. So I hope you have had a good session with both of us. We at Quantum Mutual Fund are willing to help you out, to share more information with you. Kindly do get in touch with your relationship managers to ask questions, and we shall be happy to help you out with any information that you may need. We thank you for your business and your time today evening. And with this, we conclude our today's session. Wishing you a very good evening as well as a happy weekend. Thank you so much for joining us today. We can close the call now.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.